Hey guys, Joanna Wingrove here, and I'm a realtor with Welcome Home Realty in Delaware. So today we're going to talk a little bit about different financing options and what each of them are different. Now, I will disclose I am not a lender. This is more just for your information. Every lender has a different program, but these are some that they all typically have. So, the different type of loans. My goodness, you have so many. Which one do you choose? I can't suggest that for you guys, but what I can do is I can educate you and you can have a conversation with your lender on what works best for you. So some things you may want to think about when talking to a lender is talking to them, okay, how much money do I have to put down? How much is my closing cost going to be? How much is my monthly payment going to be? What type of loan is this? Do I have any loan fees? Things like that. So, some of the loans that are out there are conventional, FHA, VA, USDA, home equity loans. So there are so many different loans out there. Now, home equity loan isn't your type of loan you use to buy a house. That's more of you need the extra money to do renovations on the house, or you can use that money to invest on another property. That's my favorite way to use a home equity loan, which we'll talk on another video about. And so for home equity loans, you could actually use that money to invest into another property, but we'll talk about that in another video on how you can use a home equity line of credit to buy your first investment home. But this one is going to talk a little bit about the different loan options. So a conventional loan, this is where your mortgage is not insured or guaranteed by the federal government. So these are typically fixed rate. They can be adjustable, but that is something that you would talk to your lender about. You would, again, ask them what your interest rate is. What's your down payment? So for conventional, it can be anywhere between 3.5% and 5% or more. If you want to avoid PMI, you want to put 20% down on whether you do FHA or conventional or USDA, any loan type. You typically want to put 20% down. Sometimes it may be more. You'd have to talk to your lender again about that. But typically is 20% to avoid PMI. PMI is private mortgage insurance, and that is so that you can avoid having to pay an extra cost later on that loan, well, in your payment on that loan. So for example, PMI can be $50 more on your mortgage or $70 more on your mortgage, something you typically want to avoid. At least from my aspect, I would definitely want to avoid. FHA is a government loan. It's backed up by the government. And there you typically have to put, I believe, 3.5% down as well. Minimum, unless you get a Delaware State Housing Authority down payment assistance grant. That's a whole different topic. I will talk a little bit more about that at the end. You could also get a USDA loan, which is government backed as well. That is a no money down loan. So in that case, because you have no money down, doesn't mean you don't need any money to go to the closing table. You still have closing costs, which is your transfer tax. If you are first-time home buyers, you're typically exempt from state taxes, at least in Delaware, and sometimes you are exempt from county taxes as well. Now, if you live in Felton, I'm sorry, they typically don't go there on the exemption on the transfer tax. So that is some of the different loans. Oh, of course, there's a VA loan. Again, no money down. They do 100% financing. Doesn't mean that they cover your closing costs though. So in that case, you may need to consider asking for seller's help or seller's assistance, and that's where the seller pays part of your closing costs. And I will say that in today's market, that's not ideal. That's not how you win a house, but I understand that some people may need the assistance. But there's also the other option of DSHA, or Delaware State Housing Authority, closing assistance. And that is where they will lend you the money to put your down payment or put it towards your closing costs, but that is going to be financed into your loan as well. So realize that if you accept that money, you're going to basically have a loan, it within a loan, and because you only have one payment, and your interest rate may be higher. So that's something to think about, but it is an option for those of you who do need it. So a conventional loan, you typically have a bigger down payment, a higher credit score, and low debt to income ratios. So in each of your different lending options, they have different debt to income ratio. So you may be able to afford a bigger house, meaning like you may be able to afford, let's just say, $210,000 on FHA, but on conventional, you may only be able to afford $190,000. Same thing with USDA, VA, different things like that. They all take into account, though, your credit score and the amount of down payment you have, so your assets. And your assets are typically what you have in your bank today. What are some things that are constantly increasing versus devaluing? So one of my assets for me is my simple IRA. It's something that's constantly increasing. It's where I have some money in. And so that's considered an asset. So when I go to purchase a home, I have to show the statements of my simple IRA, my bank statements, things like that. So that's something to think about on your different loan things. One thing I will say with conventional that's great is that if you don't put 20% down, after you do reach your 20% in equity in your home, you no longer have that PMI, which is a little different than FHA. FHA used to be like that, but now FHA, your 20%, if you have 20% in equity, you still have PMI forever unless you refinance the loan. If you refinance the loan, then that's a whole different ballgame. You no longer have PMI, which again, like I said, could save you anywhere between $50, $70, maybe even $100 a month. It all depends on your loan, all depends on how much your PMI is and all of that. So second type of loan, FHA. So this is backed up by the government. This is typically a great option for first-time home buyers because you have lower upfront cost, and then they do obviously require you to have a good credit, but it's less on your credit and more on your whole picture as a first-time home buyer. And then you have lower loan cost, and your down payment's typically 3.5%. However, FHA buyers usually have PMI, so mortgage insurance premium, rolled into your mortgage payments if you do the 3.5% versus 20%. Mortgage insurance is just where the mortgage lender is protected should you default on your loan. It doesn't actually benefit you. PMI, so private mortgage insurance, is totally different than your homeowner's insurance, guys. So don't think that because you have PMI, you don't need homeowner's insurance. And if you buy a loan, get a loan, you do need homeowner's insurance because should anything happen to your house, you need to be able to rebuild it or fix it up, and that's what the homeowner's insurance does for you. We'll talk a little bit about homeowner's insurance another day, but just a little brief synopsis on that. USDA, U.S. Department of Housing and Urban Development. This is also a loan backed up by the government. This is where you don't have to have any money down, but the qualifications for a home is very, very strict. So you need to live in a rural area, which means you're not in the city or anything like that. So you would have to talk to your lender and your realtor to see if the home is USDA eligible. My last home was in Felton and it was USDA eligible. It wasn't in town. So that's probably why it was considered USDA, but it wasn't a development. So it was technically considered a rural area, even though it wasn't a development. So you just got to know which homes qualify for that. VA, it is a veterans loan. It's U.S. Department of Veterans Affairs. These are pretty much guaranteed mortgages by qualified lenders. And this is great for somebody who's a veteran and doesn't have a down payment. Veterans also, if you've got a great lender, they typically have really great competitive rates. You know, of course, with that, sometimes it comes with money down, but for you to get a really great competitive rate, but regardless, you have a great competitive rate with VA loans. This is also the thing is, though, that if you do have a VA loan, you will have a certificate of eligibility to apply for the loan. Lenders typically limit the maximum VA loan to conventional mortgages. So you typically have the same restrictions as conventional mortgages, but it is a great option for those of you who have it. So I hope that helped clarify a little bit about the different type of loans and how their benefits. And hopefully you guys have already subscribed to this, like this video, and share it. If you know anybody who's looking to buy or sell a home, let me know.